Hi, good morning, everyone. Welcome to our Phillip Securities Research Morning Call. For today, we have a few stock counter updates, including results from Salesforce C Limited (CDL), and we also have Phillip on the ground for Daiwa House Logistics Trust. We also have the usual technical analysis, followed by the macro and sector outlook for Singapore Banking Monthly, air transport sector, Magnificent Seven, as well as the Singapore Weekly. So without further ado, I'll hand over the time to Ambrish to get us started on Salesforce. Thank you.
Thank you, Zain, and good morning, everyone. Next slide, please. So overall, the Salesforce results for the full year met our expectations, with full year revenue and adjusted PATMI coming in at 100% of our forecasts. In terms of performance for the fourth quarter, total revenue it grew by about 11% year over year to 9.3 billion US dollars, and this was mainly because of the robust demand for its products, particularly the co-products like the Sales Cloud and Service Cloud, which basically helps to enhance sales operations and provide the better customers relationships. So the revenue for these two products they grew by about 10% and 12% year over year. And integration and analytics segment revenue was the fastest growing segment, but it grew by about 21% year over year. And these segments it basically includes the data integration software, which is MuleSoft, and analytics software Tableau. And management it further highlighted that the its packaging and pricing strategy and it led to the top line growth. So basically it bundled the products instead of selling a single product, and as a result the multi-cloud adoption it helped to boost the top line revenue growth. And secondly, Salesforce it has been focusing on improving its profitability. So particularly it's like adjusted PATMI grew by about 36% year over year, and operating margin it increased from 4% to about 17.5% in the fourth quarter of 2024, and this was mainly because of high operating leverage. So particularly like operating expenses they were down 7% year over year, and this was mainly because of the prudent headcount control as well as focus on lower sales and marketing expenses. In terms of negatives, the full year 2025 revenue guidance came in below our forecast. So the company management did said that for the full year 2025 revenue should grow by about 9% year over year to 37.9 billion US dollars, and this was about 2% lower as compared to our forecast, and it was mainly because of the foreign exchange headwinds and macro pressures. But the company said that its subscription sales it should grow by about 10% year over year, and it should be led by its sales to it should be continued to be fueled by its integration and analytics segment. And also its operating margin, adjusted operating margin, should expand by about 2 percentage point year over year to 32.5%. And its bottom line, the adjusted PATMI, it should grow by adjusted earnings per share should grow by about 18% year over year, and mainly because of the continued focus on high operating leverage. Management it also noted that for the full year of 2025 it does not expect any material contribution from its AI tools like the Einstein Copilot, which basically helps to like generate personalized emails and chat replies. So it does not expect this year, at least at end of this year, any contribution from its AI tools. And lastly, it also reported a quarterly dividend of first quarterly dividend of about 40 cents per share, and increased its share buyback program by about 10 billion US dollars. In terms of valuations, we maintain accumulate recommendation, but we have increased our target price to $323, and this was mainly because of we increased our adjusted PATMI for FY25 by about 3%, and also introduced the valuations for next year. And overall, for Salesforce, the catalysts, we believe that it could be the continued margin expansion as well as the company's focus on enhancing the shareholder value, and also the strong demand for its like customer 360 platform, wherein it bundles the products and the companies they get a 360-degree view of their customer information. So that's all for me. I would now like to pass on to Helena for C Limited.
Thank you, Ambersh. Move on to C Limited. So C Limited released their fourth quarter earnings last Monday. We have published a report named More E-commerce Grows Ahead. Next slide, please. So the results are in line with our expectation. FY23 revenue was at 98% of our forecast, while PATMI was $0.7 billion below. So C has actually hit its first profitable year since its IPO in 2017. Taking a look at the positives, Shopee's strategic pivot to reinvigorate its top line growth to ramp up investment has paid off. So you can see on the left, the red bucket there, there's a 50% year-on-year surge in their e-commerce spending in order for them to compete aggressively for market share. So this has helped Shopee quite a bit. So there was a renewal surge in its GMV and gross orders, which is 29% and 46% year-on-year respectively. And the revenue grew 23% year-on-year in the fourth quarter. Shopee is focusing on the expansion of their last mile delivery facilities and optimizing routing. So that cuts costs and improves their delivery speed. We think both market gain and improved logistics signals long-term growth for Shopee. Shopee has also guided high teens GMV growth year-on-year in FY24 because its investment in gaining market share starts to bear fruit. So its new initiative, live streaming e-commerce business, continued to gain traction due to its leadership position and economies of scale. It now accounts for 15% of their order volume by the end of FY23. So SE claims to be making adjustment in take rate, especially in ads, which still has a sizable room to grow compared to their global peers. They have also disclosed their confidence of returning Shopee to positive EBITDA in the second half of 24, even as the competition picks up. The last positive point is that despite gaming continues to show a 52% year-on-year revenue decline, SE has surprisingly guided a very positive outlook for Free Fire, which is their largest and most profitable game. They say they have seen very strong momentum of the game. So Free Fire right now is the most downloaded mobile game globally in 2023, and it has more than 100 million peak daily active users in February. So both user base and bookings are expected to increase by double digit in FY 2024. So this definitely indicates a rebound in the gaming earnings after 2 years of decline. In terms of outlook, we already mentioned gaming and e-commerce. So for C-Money, the company expects similar steady growth in 2024. And so with regard to our rating, we raised our FY24 revenue growth by 2% and PATMI by 280 million. This is because it's driven by higher e-commerce and gaming growth. We have raised our target price from $61 to $70, but we downgraded it to accumulate this due to the recent price gain. That's pretty much from me. Now I pass my time to Glenn to talk about Singapore Banking Monthly.
Thanks, Helena. Yeah. So for the Banking Monthly, we'll first jump straight into the brief highlights of the all three banks' results. So we can look at the chart here. I mean, the adjusted earnings were sorry, the fourth quarter earnings, sorry, typo there, were all slightly above expectations as PATMI rose 7% across the board. And this is supported by the fee income growth of 21% year-on-year, mainly due to a rise in their wealth management fees as the card fees continue to sustain its momentum. So if you look at the table here, you can see that the fees were actually the one that boosted continue to increase their earnings. So looking at their NIM and their net interest income is as expected. It has moderated, the NIM has moderated, and it actually dipped by about 5 basis points across the board. And loans growth was flat as well, but net interest income still did manage to grow slightly by 1%. So for their FY24 guidance is for the net interest income to remain stable, as we do expect a few basis points dip in the NIM, mainly due to the rate cuts that will be expected in the second half of the year. And they will stabilize at around 2 to 2.25%. So loans growth is expected to pick back up slightly at around low single digit for the year, but this will most likely only come in the second half of the year. And in the first half, you'll still see a slight dip in the loans growth. So fee income will be the growth driver for the banks, and it's expected to sustain the earnings with an expectation of around double-digit growth for FY24 for all three banks. The provisions guidance is also expected to remain stable, around 17 to 30 basis points for three banks. So the CET1 ratio, look at the last column here, it's still quite high at 13.4 to 15.9%. So, OCBC is, I guess, the main outlier here. They have the highest CET1. So during their calls, they also mentioned that, they are trying to reduce this, but they didn't specifically say in what way. So they're not saying they're not going to increase dividends. So we might see a further increase in dividends. I mean, as for DBS, they have really explicitly said how much they're going to increase dividends by. And for UOB, they have said that they will be maintaining it at 50% dividend payout ratio. So that's all for the banks. I'll now move on to the interest rates. So for the Singapore interest rates, is the 3-month SORA did continue to dip in February, and it did at similarly in January at 5 basis points month-on-month. So it's now at 3.64%, but it's still up 43 basis points year-on-year. And it's also, so now it's 10 basis points lower than the fourth quarter average of 3.74%. For the Hong Kong interest rates, the 3-month HIBOR was down 14 basis points month-on-month, and this is smaller than the decline of 55 basis points in January. But nonetheless, if you look at it year-on-year, it's still up 112 basis points, but it is 66 basis points lower than the fourth quarter average. Now moving on to the loans growth. Next slide, please. Yep, so for the loans growth, we did see sort of an improvement. So it is still declining, but it only fell by 1.59% year-on-year in January. And this is the smallest decline that we have seen since December 2022. So we do still expect a low single-digit growth for 2024, as it's expected to turn positive in the second half of the year. So for business loans, it fell 2.84%, and loans to the building and construction segment fell 1.17%, while the manufacturing segment fell 11%. The consumer loans actually grew for the first time since December 2022. It grew by 0.4%, and the housing loans grew by 1.34%. The total deposits and balances also continued to grow and grew by 5.7% in January. But this was mainly due to an increase in the fixed deposits, as the current account and savings accounts proportion dipped slightly to 18.1% from 18.5% in the previous month. So we can see that actually the CASA proportion has been quite stable at this around 18% range. So we do expect this to continue moving forward. For the Hong Kong loans, the loans growth declined 5.6% year-on-year and 0.8% month-on-month in January. Now moving on to the next slide, we'll be touching on the SGX statistics. So the SDAV rose 12% year-on-year to 1,242 million in February, and the DDAV grew 5% year-on-year and 10% month-on-month in January. So the VIX, which is a market index that measures the implied volatility of the S&P 500 index, averaged 14 in February, and this is up from 13.4 in the previous month. For the top 4 equity index futures turnover, it rose by 6% year-on-year, and this was mainly due to higher trading volumes of the FTSE China A50 index futures and the MSCI Singapore index futures. Now moving on to the next slide. Yeah, we'll have a brief recap on the bank's performance in February. So the 3 local banks' share price performance was quite mixed in February, with DBS performing the best at an increase of 4.7% in February, and OCBC improving slightly by 1.1%. So UOB was the worst performer. It declined by 1.4%, and this was most likely due to the lackluster dividends announced, as well as them sort of keeping it at a 50% dividend payout ratio. And DBS was the best performer. This was most likely due to the increase in dividends, as well as their 1-for-10 bonus share issue. And as you know, looking also at how they are moving forward into this year and next year for their dividends at least. So the dividend yield now is currently, we're looking around 7.2% if you include the 1-for-10 bonus share issue. Now moving on to the next slide. Yep, so as such, we maintain overweight and remain positive on the banks. The NIMs for the banks were likely to remain flat in FY24, despite the higher for longer interest rate environment, but a recovery in loan growth as well as fee income will uplift profits. The bank dividend yields are also very attractive now, with upside surprises due to excess capital ratios and a push towards higher ROEs. So that's all I have for the banking sector. I'll now hand it over to Darren. Thanks.
Yeah, thanks, Glenn. Yeah, so for CDL, yeah, the results came in mainly because they had higher revenue, mainly because of the property development segment where they fully recognize the Piedmont grant. Yeah, so for the results, it was slightly under our estimates, mainly due to higher finance costs. And so like I mentioned, they fully recognize the Piedmont grant EC during this quarter, or rather during this full year. So that is why they had record revenue. And other than that, for PATMI, it was down by 75%, as you can see, mainly because of the recognition of the $900 million divestment gain, which was recognized in FY22 for Millennium Hilton Seoul, and as well as the deconsolidation of CDL Hospitality Trust that was last year. So as a result, there was a lot of the PATMI, it fell by 75%. Yeah, so if we exclude this divestment gain and impairment losses, the full year 23 PATMI quadrupled actually to 188 million. Yeah, so for the positives, like I mentioned, the property development segment, there was record revenue. So this was due to Piedmont grant, and they also sold another parcel of land. Yeah, so in this full year, the group and its JVs, they sold 730 units. So this was lower than about half the amount sold in FY 2022, and with about half of the value as well. So 1.5 billion units, and compared to 1.5 billion in value compared to 2.9 billion value in the year before. So this was mainly driven by the Mist and Tembusu Grand. So for their launch pipeline, they have two upcoming launches. So one is Union Square Residences, comprising about 366 units, and another one is at Champions Way, so 348 units, that one. And there's a Newport Residences that got delayed last year because of the 60% ABSD, so they're still monitoring the situations there. And the good thing is that they for this project, Newport Residences, they do not have any ABSD timeline. Yeah, the other positive for CDL's results were that the hospitality segment continues to improve. Their RevPAR is now 22% above pre-COVID levels, and the gross operating profit margin also has improved to 34%. And they also continued to expand their hotel portfolio in full year 23. Yeah, they acquired 3 hotels with a total of about 1,000 rooms. Yeah, so for the negatives for this set of results, the cost of debt, it was higher than we expected. So it rose from 2.4% to 4.3%. So this is close to double, but it's not quite double. Yeah, so the 73% jump in finance costs. And as a result, their gearing also, the gearing is based on the fair value of investment properties. So after we account for the fair value, it rose to 61%. So this is 10% higher than the year before. Yeah, so for the outlook, CDL, they are now targeting $1 billion in divestments. And any possible divestments or any successful divestments, it could result in high divestment gains, as we've seen from the sale of the hotel in FY22, as mainly because they carry all the assets in at cost in their books. And for the property development segment, the headwinds still remain, especially with the 60% ABSD for foreigners. So basically, the foreigners have already evaporated from the market. And we also think the hospitality segment will continue to improve. Like we've just seen the Taylor Swift concert end. So yeah, the RevPAR for this week was basically 30% higher at least. So yeah, all these mega events and MICE events will help to continue to boost RevPAR, as well as this 30-day visa-free entry between Singapore and China, which started 9 Feb. Yeah, so with that, we maintain our buy call on CDL, but we lower our target price and to $6.87. And right now, the target price is tagged to a 45% discount to our RNAV of about 12.50. Yeah, so that's all for CDL's results. Yeah, so next we'll have some update. We hosted Daiwa House Logistics Trust last week for a corporate insights webinar. So these are just some quick updates. Yeah, so it's a Asia-focused logistic REIT. 100% of the assets in Japan. Before the acquisition, they announced the acquisition of one of the cold storage in Vietnam from the sponsor at the start of the year. So if you exclude that, it's 100% Japan. And yeah, and for the full year 23 results, basically the gross revenue declined because of the weaker yen against the Sing dollar. But because of the hedges in place, they realized some of this gain on hedges, and as a result, the distributable income increased by 3.1%. So if you look on Japanese yen terms, the MPI grew 4.6%. So that's the chart at the bottom, the two graphs. And revenue also grew 4.7%. Yeah, so right now, as of FY23, the portfolio occupancy is at 100%, and 23% of the leases are up for renewal in 2024. So for the capital management front, because they are borrowing in yen, the borrowing cost is still very low, 0.99%, and they're 100% fixed, and they have a gearing of 35.2%. So that's a plus for Japanese yen. For the Japanese REITs, mainly, but for the rental reversions, right, for the leases, they do not have any escalation, and it's quite challenging. Like the rental reversion and is harder for Japanese properties, or rather the leases, to get a higher rental reversion because of the way that the Japan is. Yeah, so basically when they negotiate, most of the time the reversions are flattish or low single digit. Yeah, and for portfolio valuation for FY23, they're 1.8. It grew 1.8% in yen and is down 5.9% in Sing dollar terms. Yeah, mainly because of the depreciation of the yen, like I mentioned. Yeah, so for the outlook, the logistics in Japan, it continues to remain healthy in the long term. So because of these few factors, so number one, the demand is coming from the 3PL, the third-party logistics and e-commerce companies, as all these e-commerce penetration continues to grow. And next is there's a restriction on overtime for truck drivers. So this is expected to create new demand for logistics facilities that are nearer the regional areas. And there's also a nearshoring where there's returning of overseas production back to Japan. So this is mainly from semiconductor and automotive industries. And because of the rising land prices and increasing construction costs as well, we expect the supply to be muted upcoming in the near term. Yeah, so Daiwa House right now, they are trading at a dividend yield of about 8.8%. Yeah, so that's all for me for Daiwa. I'll hand over time to Peggy to talk about air transport. Thanks.
Thank you, Darren. Good morning. We had a monthly report on air transport sector last week. Briefly, the three major events happened in February 24. Is that the three aviation-related stocks in the Singapore market, the share prices were down. Sharpest was SETS, which was down like 4.7%. The decline was mainly because their third quarter earnings update, third quarter ended December, disappointed. SIA operating profit fell 19.3% year-on-year, despite third quarter being a seasonally strong quarter. The decline in operating profit was a reflection of a yield decline as well as a higher cost pressure. For SETS, the EBIT margin, they managed at 8.8%, which is still less than like the average of 17% they achieved pre-pandemic. And SIA Engine was still incurring operating loss. During the same, in February as well, the US Transport Department allowed the Chinese airlines to boost their weekly round trip US flights to 50 from 35. So which means there's 100 round trips because when they allow the Chinese to fly, they also allow their own US airlines to fly to China. So this number is about 1/3 of pre-pandemic level. So there's still room to grow, and there's a bit more lifting of tensions between China and Europe, and China and especially in United States. We will see more of these flights returning, and that put pressure on the entire industry. Is you have more capacity added on, passengers have more choices. At the same time, as they fly, capacity increase, they fight for slots at the airport. They need more services on the ground. So there's a fight for staff costs are expected to rise. Okay. In Singapore, the minister also announced that the flights flying out from Singapore Changi Airport will need to use 1% sustainable aviation fuel in 2026, and this possibly could rise to be lifted to 3 to 5% in the year 2030. So and to help the airlines to cope with this increase, they are allowing the airlines to impose a levy. At the moment, the suggested levy is about $3 for a flight to Bangkok or $16 to London, which looks small. Passengers are very used to paying levy, especially during times when the jet fuel prices were high. So this number doesn't look significant, but because SAF is about 3 to 5 times more expensive than the conventional jet fuel. So if the requirement is raised to 5%, we're not sure whether we do not think the airlines would be able to pass on all the increase in the fuel cost to the passengers. Otherwise, you might see a reduction in the travel demand. So there will be some impact on the margins for the airlines. Singapore Airlines and Scoot has already committed to use 5% of their fuel as SAF in the fuel composition by the year 2030. Okay, next slide, please. Thanks. So these are some charts to just guide us through. SIA for the second consecutive month had a year-on-year decline in the passenger load factor, meaning to say that the passengers are having more options and choosing other carriers. Okay, but the passenger seat capacity, seat kilometer, which is the number of seats being filled multiplied by the distance, is already 1.5% higher than the pre-COVID level of January 2019. So with this data, we feel that we believe that the passenger loads could have reached a peak for Singapore Airlines. Okay, next slide, please. So in terms of cargo, we see a very strong cargo numbers in the month of January. Year-on-year, SIA cargo volume grew 20%. And even for the Changi Airport, there was a 17.3% increase in year-on-year. Two factors. One is if you look at the chart, January 23 was a very low, very steep decline in the cargo loads. The other factor is that Red Sea conflict could have moved some of these more time sensitive cargoes to take on the air freight. But the cargo freight rates have already, maritime cargo freight rates have already normalized from late second half of February after the Chinese New Year. So we think that this phenomenon is going to be very short-lived. Thank you. Next slide, please. Okay, so for SATS, just some brief run through of their data. The flights handled in the third quarter was 14.3% below the third quarter 2020, which is the pre-COVID level. So we also they seems to suggest that they have been losing some market share to others competitor. But meals produced is now 6% below the quarter 20, also suggesting that and you notice the decline, the slower growth compared to second quarter, seems to suggest that this number is going to plateau from here. Okay, for the China international travel, there's still about 38% of FY19's level going by this chart here. So there's still a lot of room for China international passenger volume to rise, and that would benefit the China aviation oil. Okay. I think that's all from me. Pass on to Zane. Thank you very much.
Thanks, Peggy. I'll move on to the technicals. So for S&P 500 last week, we saw it continue to trade in this short-term uptrend channel over here. So for the week, it was down like 0.1%, like almost flat. For this week, we are likely to see continued consolidation ahead as it remains likely remains in this uptrend channel. So for now, for this week, the current resistance like 5,165 to 5,220, while the support is likely between 5,055 to 5,110. For technical calls, first one, we have a technical buy for Olam at $1.02. Take profit levels at $1.08 and $1.13. Stop loss at 97.5 cents. Stop loss goes at $1.05. So for Olam, there was a breakout of this downtrend resistance line. And also, there was a signs of a bullish reversal with a higher high and higher low form after a gap up. And also, there's increasing momentum displayed on the MCR side as well. So it potentially retest these two higher resistance levels. Then for the next one is Walt Disney. So for this, your technical buy $113.69. We take profit level at $126. Stop loss at $110. The stop loss goes at $110.32 on Friday. So for this trade, actually hit our stop loss. The original idea was that there was a break above this bullish flag consolidation after a consolidation between $107 to about $113 with increasing momentum. Also, following a breakout of the downtrend resistance line as well. So it could potentially continue momentum upwards. The last one will be on Dynamic. So for this is a technical buy at 31 cents. Take profit levels at 34.5 cents and 37.5 cents. Stop loss at 29 cents and the stop loss closed at 32.5 cents on Friday. So for Dynamic, after forming a double bottom at the 24 cents level, it has showed strength, breaking out the downtrend resistance line and also holding above it. So with the increasing momentum, it could go on to retest these two prior resistance levels. So this is just a summary of the trades initiated. Olam is up about 2.9%, while Disney hit our stop loss, so it was down 3.2%, and Dynamic is in progress as well, up 4.8%. So that's all from me now. I'll pass on the time to Jonathan to talk about Magnificent Seven Monthly. Thank you.
Thanks, Zane. Good morning, everyone. So I'll just be running through just our usual monthly update for the Mag 7. Next slide, please. So overall, just performance-wise, the group of companies in the Mag 7 was up 8%, so it's far outperforming the S&P 500 and NASDAQ. Biggest gainers were Meta and Nvidia, mainly because they blew their earnings out of the park. So you see that 25% and 30% gains, quite significant. The biggest laggard was Apple, that was down 2% due to continued softness in iPhone demand. So overall, for a lot of these Mag 7 companies, AI is still the main driver. But when you look at valuations right now, it's still seemingly forward price to earnings valuations is coming in about 29 times. So it's still below its long-term 10-year average of about 35 times. So we still see some sort of value there, because there's a lot of upside from earnings. Next slide, please. So we'll just briefly run through some of the updates for these companies. For Meta and Alphabet, main news for the month of February was more, I guess, lawsuits in Europe. There's nothing new. Every year they've just been fined, coming under siege from a lot of these consumer groups and more news media outlets, basically trying to get some sort of share or some sort of compensation from these companies' dominance in the market. When it comes to Nvidia, earnings was really good. Now something quite interesting is that they are beginning to set up a new custom chip design business unit. So for the most part, right now they just design these AI GPUs for use by the mass market or as mass enterprise market. But for right now, they kind of see this niche design business unit where they're going to be working together with big names, big cloud computing names like Amazon and so on, to develop more specific chips solely for use by these companies. And then at the same time, also going to start looking at customers from some other industries like telco, auto, as well as video games. So it's more of an expansion in terms of a business model and increasing revenue flow from other sources. For Tesla, it's kind of same old story, having intense competition in China. Right now, the Chinese EV industry is battling quite a severe oversupply, as well as very high inventory. So this is leading to a lot of price cuts for a lot of these EV manufacturers to keep moving that inventory, because there's a lot of cars that are just sitting on the lot right now. In terms of EV sales, China-made EV sales, so it's not just sales to China, but sales to around the region, like even the EVs that are sent to Singapore, most of them are made in China. For Tesla, China-made EV sales was down 20% in Feb, mainly due to the Chinese New Year. We look at other major EV manufacturers, like BYD, NIO, and XPeng, they also saw about 25 to 35% dips. So kind of dips just across the board because of the seasonality compared to last year, where Chinese New Year was in January. So in terms of our calls, we maintain and accumulate for Meta and Alphabet, neutral on Tesla, and then a buy on Nvidia. Next slide. For Apple, like I mentioned earlier, sales in China remain fairly weak, and sales in China represents about 20% of total revenue for Apple, so it's quite a big portion. A lot of the resellers there are actually cutting their iPhone 15 Pro Max prices by about almost $200, so it's quite a significant cut. And this is kind of the same story. It has been the same story for quite a while now. Not kind of intense competition from Huawei and other Chinese manufacturers. In the US, there's something similar going on. iPhone sales were down about 10% in January, but they still represent about 65% of the market share there. So they're still very dominant in more Western countries like the US and perhaps some parts of Europe. But when you look at China and Asia and so on, they're kind of losing their share to a lot of the Android competitors. Another big news is that they are stopping work on the Apple Car, which is coined Project Titan. Previously had set a release date for 2028, so very far from now. But I think when we look at the EV industry and the intense competition and how margins are continuously getting cut, I think they realized that it was a project that maybe it was a bit too much for them, too time consuming and too much loss making. So just decided to scrap that. For AWS, the story continues. They're trying to expand into different markets in terms of cloud infrastructure. So the latest news is investing $5 billion in Mexico over 15 years. At the same time, they're looking at more regions to expand into to kind of cover to have more of a global footprint, as if they didn't already have a global footprint. But essentially, adding more data centers, adding more infrastructure, so they can maintain their market share, their leading market share in their cloud space. For Microsoft, they actually invested in Mistral AI. It's a developer of LLMs. So similar to ChatGPT. Essentially, they'll just take a minority share in this European company. But I guess the hope is, and the aim of this partnership is to kind of collaborate, and try to add into their own portfolio whatever they learn from Mistral AI to improve their LLMs and their AI technology. In terms of ratings for these companies, we have a neutral on Apple, and accumulate on Microsoft, and a buy on Amazon. Next slide, please. Yeah, so just to conclude, we remain overweight on the Mag 7. Still think AI-related demand is very robust, although there is a little bit of softness in tech hardware as well as EVs. We still think valuations are quite attractive for right now. So that's all for Mag 7. I'll move on to the Singapore. yeah, in terms of what happened last week for Singapore macro, it's not much, just retail sales. It was up 1.3% compared to a decline of 0.5% in December. So January's numbers versus December. Kind of the big standouts were motor vehicles and F&B. That really jumped quite significantly. Motor vehicles because COE dropped quite significantly due to higher quotas. F&B just because tourism is starting to come back, or has been coming back for quite a while now. For the US, quite a lot of macro numbers came out. Non-farm payrolls, the US added 275,000 jobs versus forecasts of 200,000, so quite significant, a beat there. At the same time, unemployment rate for some reason ticked up slightly to 3.9%. But the key highlight for the US is Fed Chair Powell's testimony to the Senate and the Banking Committee. He continued to mention that they're still very data dependent, although they are not far from being confident enough to cut rates. So essentially implying that they'll cut rates, sometime in the next few months, possibly in June. And they also mentioned that they're very conscious of a potential recession risk, if they continue this current restrictive policy for longer. Yeah. So next slide, please. In terms of our week 11 tactical views, with further confidence of rate cuts in the US, and more economic data pointing to a more resilient US economy, we still think that long duration bonds should stand to benefit because of their inverse relationships as interest rates start getting cut soon. Sorry. In terms of the equity markets, you see some sort of weakening in the equity markets, especially after Friday's close last week. Equity markets have run up about 10+% year to date. So we think that there is probably some room for some sort of a pullback before moving up further. In terms of earnings still remain very strong for most of the S&P 500 companies. You look at the companies outside the Mag 7, for earnings for last year weren't really very good, and they're expected to grow quite significantly for this year. So that should help to boost at least the S&P 500 till the end of the year. In terms of locally, we still think that the hospitality sector will benefit from a strong events lineup in 2024. You can see a little bit of that pointing towards that from the retail numbers in January. We expect F&B operators as well as hotels to benefit because of a steady stream of tourists, and you start to see that from record RevPAR rates, RevPAR numbers, increasing sales from F&B operators. In terms of the week ahead, for the events, core inflation numbers or CPI and core CPI numbers are coming out for the US on the 12th of March, so tomorrow evening. So it should be quite important to watch these numbers to see if it kind of trends further down, or if there's any blip in inflation expectations. In terms of company earnings, we have one more, which is Adobe's first quarter 2024 results that are coming out on 14 March after hours. So that will be 15 March early morning for us. In terms of our events, our corporate insights webinars, we've got OxPay on the 12th, Yoma, Takraw, and UniAsia. So that's all for me, and that's all from us. I think we can head to questions now.
Yeah, maybe I'll just take this first question in the Q&A. I was asked quite early. So, any idea how the three Singapore digital banks are doing? I think you're talking about Trust Bank, GXS, as well as sorry, what was the last one? Yeah, GXS, Trust, as well as Marybank, which is by C. So yeah, so for these three banks, they don't really give an update on how much deposits they have and so on and so forth. But they did say, maybe in the last year, they did say that their deposits have been increasing and they are quite aggressive with trying to get in the customers, the initial step into the door. So they give very high interest rates at least compared to the local banks, and there's not really any sort of loopholes you must go through. Like for the local banks, you have to spend this amount, have your salary credit, or whatever to get that high interest rate. But for the digital banks, they don't. They just say, okay, you put in this amount of money, you get this amount of interest. So the interest is quite high. I think they're giving 2 to 3%. Yeah. So I think for this year, at least what we'll be looking at for these digital banks is how they're going to incorporate it into their existing sort of ecosystem or environment. So if you look at a Marybank, and maybe even the GXS Bank. We'll be looking at how they're going to put more features and try to sort of be able to offer more products into their systems like Grab or even Shopee. And we should see that coming in more, and this should improve their fee income for at least for these two banks. And lastly, for Trust Bank, I think they will be trying to bank more on their NTUC link and trying to expand further into that. Yeah. So hopefully they'll give an update soon, and then I can provide an update when they do come out with it. Yeah, hope that answers the question. I'll hand it over to the rest of my colleagues. Thanks.
Sorry, maybe I add on to that a little bit for the digital banks. The issue with Singapore is that there's a $75,000 cap for deposits, so it kind of limits a lot of what they can do here. But when you look at GXS Bank, for example, which is Grab's digital bank, I believe they started GX Bank, which is basically a digital bank in Malaysia, and Malaysia has no cap. Within the first month or so, they received about 300 million worth of deposits, US dollars. Whereas for Singapore right now, I think you get very close to like not even 100 million or so. So there's quite a significant, I guess, limitation in the Singapore markets. But when you look at overseas markets like Malaysia, Philippines, Indonesia, that's kind of where they're targeting. And that's where they can do a lot more with, I guess, lesser regulations, a little bit more lending because of the significantly higher unbanked population. So that's all. Just wanted to add that. Sorry, Darren. One more question here. There's a question from Luke. Can I confirm the numbers? Max 7 PE is currently at 26. Actually, it's 29 times versus the 10-year average of 36. Yeah, it's correct. The forward PE is 29 times versus 26. Hope that helps to answer. Hand it over to Darren.
Yeah, thanks, John. Yeah, some questions from Luke also in the chat. If financing cost for CDL is so high, any project risks are returning back to bank? Yeah, so we don't see the risk of this happening. So first of all, because CDL is very well kept, they have about $2.4 billion of cash sitting on the balance sheet. So that is one good thing. Like they are well capitalized, and they also do not have any financial covenants that are in danger of being breached. Like unlike some of the REITs where they have the 50% MES leverage limits, yeah, CDL do not have that. So we don't see that happening. And with rate cuts expected probably in third quarter, will we expect a jump in valuation? Yeah, so we expect that, but there will be a delay of maybe a couple of 1 or 2 years. It won't be immediate impact also. So we do expect cap rates to compress back, but it will take some time for it to affect the valuations. So perhaps in 1 or 2 years, then we expect the valuations to be better. What is CDL dividend yield? It is at 2% right now, about 2% flat. Yeah, so it's not really a dividend yield stock. It's more of I would say growth stock rather than a dividend yield stock. Yeah. What is the gearing of Daiwa? Since the dividend yield 8.8 sounds attractive, yeah, the gearing is 35%, so it's very low and well within the MES leverage limits of 45%. Yeah, thanks. So that's all from me. I think there's a question for Peggy.
There's a question for me.
Thanks.
Yeah. Okay. The question is over COVID, PSR call to underweight SIA after the price run for some time. Am I right? Note that your SIA slides format for cargo not visible. Okay. We first had a reduced call on SIA when in June last year. There's about 8 months now. We still think it's a reduced because it's still trading about 8% above the forward book, compared to if you are a fund manager, you have a choice to buy others like Cathay Pacific is like 10% below book value. So then those look more interesting. Or even in the aviation space, the leasing companies could be a better bets with the interest rate coming down, and also with so many more airlines adding new flights. The first thing they will do is to latch on to a leasing company to lease their flights. So demand is strong, and the yield spread is improving for the leasing company. So for this reason, the Singapore aviation stocks look pale in comparison to those listed regionally or in the regional markets. I'm not sure where the cargo not visible. I'll check that out. If I can, I'll correct that for the 11 o'clock session. Thanks. I pass back to.
Thanks, Peggy. I have a question for the TA regarding the air transport sector. So I'll just share the charts for the aviation stocks. Yeah, so the first one, I think I'll talk about SIA. So regarding for the current chart wise, I think it's still it's starting to flatten out a bit with some support around 640. So yeah, for now it's still overall for now it's still a little bit bearish. But I think it could just flatten out a little bit more for the time being consolidation. Then regarding sets. Regarding sets is still looking quite bearish. Currently still trading in this blue color downtrend channel over here. Yeah, so for now, you might go on to hear about 250, around 252 over here. They might just go sideways for a while. But overall trend wise, it's still downwards. And as for SIA Engineering, SIA Engineering has been quite range bound overall. So just holding at around 228 over here. But if it breaks this level, then we're likely to see around 223 as the next support level. Yeah, so overall for the three aviation counters, they're looking a bit bearish or sideways in the near term. Thanks.
Okay, I think that's all that we have for today. Sorry, we overran a bit. Thanks for joining us. We hope to see you 11 a.m. webinar. Have a good week, everyone. Thanks for joining. Bye-bye.